Well, they all look like they're winners, but not really.
They are all winners if you do it from an index perspective,
yes.
right? So if you just invested in things like the Qs or a Spider ETF or something like that, all of those trades have been winners. If you just take a look at this, because the Investo QQQ Trust, the one that tracks the NASDAQ 100, you can see they're up 19% just if you just bought it and just held it for the year to date. That's a pretty big move. The Spider ETF up about 8%. But it talks about these divergences we've been highlighting in the marketplace. We'll highlight 3 different pairs trades, a long-short transaction, just to show you the kind of discrepancy that we're seeing at the sector level and industry level, just among stocks that are fairly similar in nature. If you take a look, first of all, at one of the big ones out there, in the financials themselves. JP Morgan Chase, no doubt they've been one of the bigger bank performers out there. Meanwhile, another money center investment type bank, Citigroup out there, has not fared nearly as well. So if you would have just bought JP Morgan and sold Citigroup, it would have been a great trade so far this year within just financial services. Another place to look at is within energy. We know rising oil prices have been lifting that tide for many of those stocks out there. But if you're an exploration and production company benefiting from rising oil prices, as opposed to an oil services company that should also be rising as well, you'd think that that trade would work out for both. But no, Marathon Oil on the exploration and production side up 41% just so far year to date. Halliburton down about 15%.
Is that a Halliburton only story, or is this across the entire oil
No,
services?
because Schlumberger is the same way. You'll see some weakness in that oil services sector as well. You'd think that with many of these, they would get lifted up. People may drill more as they start to get right. Exactly. Right. So the fundamental picture there maybe is not the same. One more place I would look there is in the industrial side of things, where you can see a real divergence happening within just 2 competitors. And this is a big one here, airlines. United Continental up 29% just so far year to date. Meanwhile, a large competitor of theirs, American Airlines, is down 25%. So as we talk about the winning trades out there, we say that active stock pickers are not doing very well and that passive index managers are beating them, the index funds are. But if you looked at some of the places where these divergences are really happening, it could tell you a little bit more of the story about whether or not there are reasons to still want to try to be a stock picker, especially if the market seems like it's at a record level where it can only go higher. As things start to maybe pull back a bit, because we know they do, then those active stock pickers perhaps get back into the fold and start to outperform a bit.